Welcome back to another FOMC meeting. It is March 22nd, expiration of coupon day, and of course the day my daddy gets to talk on national television. Yes, that's Jerome Powell. And we've got a lot of divergence in expectations. In fact, we have 75 bips of divergence between the high and low right now of what the hell we're going to get. That's because we actually have no more research that thinks we're going to get a cut of 25 bips. We have about 10 Wall Street economists interviewed by Bloomberg expecting a pause. And then we've got about 89 sitting at a 25 BP. You actually have some people thinking, oh no, we're going to get 50. So you've got this massive spread in terms of what people think we're going to get. The vast majority of people, including myself, are convinced we are going to get a 25 basis point hike. Reasons are simple. Number one, the Federal Reserve does not want to signal that there is more financial or banking stress than there really is. They have other tools on their tool belt to handle that. Number two, they don't want to go back to the start-stop policies of the 70s. They've made that very clear to us that they want to stay away from pausing and then rehiking and pausing and rehiking. So we're likely to get 25 basis points. Now, whether or not this will be the last hike that we get from the Federal Reserve will determine whether or not what we're experiencing now is a Federal Reserve U-turn, or will we eventually be having a Federal Reserve pivot? That's actually a big deal, and we'll see in the summary of economic projections where we end up going directionally. The summary of economic projections is this document that will be released within the next few minutes here. And what we're going to find is the Federal Reserve's expectations for the fourth quarter of 2023. We're going to compare those to their December projections. They last told us that we would end up expecting data that was higher than this December data. However, that was before the banking crisis. So now that we have a banking crisis, folks think there's a possibility that the summary of economic projections could actually come in with lower projections. Now, a lot of people debate what the Fed pivot or the Fed U-turn ultimately ends up meaning. And I have a simplified definition for us here in terms of what that means. So hopefully this can help us. And I want you to look for hints throughout Jerome Powell's presser on exactly these topics, because I think they're actually quite useful. So here we go. This chart right here shows you Fed pivots in very short, sort of 60-second simplified information. On the left, you have when the Federal Reserve started cutting rates back before we actually were comfortable with the idea of fiat, right? All of the inflation and the problems we had of 73 and 81, the Volcker recession, were all related to leaving the gold standard fiat, inflation, price caps, and all the crazy policies of the 70s. It was really only the pivots of 2000, 2007, and 19 that we had post-fiat or introduction of fiat, so to speak, versus gold concerns. And in those eras, we've noticed that in 2000 and 2007, the Fed cut rates, and that actually led stocks to fall more. But interestingly, the Fed U-turned nearly at the bottoms of the markets in March of 2000, in February of 2009, and in March of 2020, and in December of 2018. Those all ended up actually proving to be pretty decent, with a little bit of volatility, pretty dang decent for stocks. And so in my opinion, a U-turn is when you have an official pausing of policy, a change in direction of policy, and a bailout because they broke something. That's what we had in 2009. That's what we had in 2003. That's different from just, oh, we're going to reduce rates because, well, we have to because things are starting to slow down in the economy, right? Reducing rates in 2000, 2007, 2018, those were all responses to the market. Whereas what's happening now is the Fed is responding to something else. The Fed is causing this recession. The Fed is, in theory, the problem. They printed too much money. Now they're trying to solve their own problem. It's kind of interesting. Anyway, so the first thing that we're going to do is we are going to make sure we get the lower bound and upper bound read off to you right away. Then we're going to go through the Fed's policy statement. All of this is expected to come out in roughly about 20 or so seconds, so we'll be covering this. Keep in mind that we're looking for 4.75. 4.75 is what we're looking for to get a 25 basis point hike. I highly expect it to be 4.75. Here we go. And it is 4.75. We got the 25 BP right along expectations. Not a surprise at all. Shouldn't see much movement off that. Now we got to get the summary of economic projections. That's the next big deal. Summary of economic projections. The statement is out. Implementation's out. Okay. 75 BP. Tighter conditions of credit for households and businesses and expect them to weigh on economic activity, hiring, and inflation. That's actually a big deal. That they're referencing tighter economic conditions. That amplifies the Federal Reserve's hikes, right? I'm trying to get the summary of economic projections, but that has not been posted yet. So let's just go ahead and go through their press release alone here. They say the U.S. economic system remains on resilient ground. We've got forecasts. Here we go. Median forecast, 5.1. They're keeping it stable at 5.1 on the SEP. They didn't go up and they didn't go down. I actually think that's bullish. They're keeping the same pace for reducing treasuries, holding on mortgage-backed securities, so no change there. That's interesting. 5.1. I really want to see that dot plot. Waiting for it to post on the website here. This is all coming through the wire right now in terms of these updates that we're getting. So waiting for. Oh, here we go. Projections are out. And the projections, in my opinion, are the most important. And then we'll go through the policy implementation statement as well. So here are the summary of economic projections. Wow, I'm surprised. Look at that, folks. They kept the projection the same. They actually think there's their higher for longer. Oh, okay. That's the higher for longer going up to 4.3 instead of 4.1. Okay. Oh, look at that. They actually moved this slightly closer to recession in 2023. Usually they do not go under 0.5. That's interesting. Then they're actually keeping us out of a recession in 24 and 25. Unemployment rate 4.6, PCE inflation. And you can see the previous estimates here. They did reduce GDP both for 23 and 24 were reduced. So lower GDP in 23 by 0.1%, lower GDP in 24 by 0.4%. That's 400 basis points. Unemployment rate, they are refusing to signal any kind of increasing pain in the unemployment rate. Stocks, by the way, seem to be liking this. This is kind of what we wanted. This was my best case scenario, was 25 and dovishness. Now, I thought this might be a little bit more dovish right here, but that 5.1 on the median is a little higher than I thought. Look at this, folks. They're keeping inflation expectations for PCE stable, slightly higher for 2023, stable into next year. Core, slightly higher, but mostly stable here. No Paul Volcker, no runaway inflation. What were the ranges that we got for GDP? Look at that central tendency right here. Somebody's actually knocking on the door of recession. Look at that range right there. Change in real GDP, 0 to 0.8. That's a little bit of a red flag. That's a recessionary red flag right here. Look at that range. There's your recession. There it is. But we also had that range projected last time as well. So one of them is actually getting us a little bit closer to out of recession, whereas previously they also thought we might see that recession. The range is sort of the low versus the high, right? The median is a type of average, right? It's supposed to represent the middle. Let's look at the dot plot. What do we got for the dot plot? Wow, they're actually a whole lot higher than I thought. They're all consistent here for 2023 Q4, pretty much all staying above that 5% line. Now, I want to compare that to what we had in the last dot plot. So let's go to the last dot plot, which was right here. And let's go here. Kevin's estimates were wrong. So I'm going to erase these. So that looks pretty similar. You had 2 dots below for 2023, all of them above, with 2 dots as high as about 5.675. Going over here, yeah, you've really just consolidated around that 5.1 level. So they're sending a signal here that we still have 1 or 2 hikes left in us. So this is really telling us that we're going to get our March 25. We're not going to go down. We're not going to pause yet. We have to deal with what's remaining to be elevated inflation. I would say this is no signal of stress in banking, really. We are probably setting up for a May 25 as well. This will take us to 5%, right, on the lower bound. And a 5 on the lower bound is probably in line with that tendency of 4.1%. So the federal funds rate being at 4 or 5.1 rather, it sits right there in the middle of one more hike in May and then done. That's about where we sit. So one more before done. I think it's too soon to call for a pause. I expect Jerome will tell us he's being data dependent. That's not going to be much of a surprise at all. Looking at, the dots moved up a little bit. The Fed, let me see really quick what else we have here. What are the suits saying? Like most economists, the Fed does think that banking turmoil will affect the economic outlook. Recent developments are likely to result in tighter credit conditions for households. Yep, we expected that. You got Tesla popping off a little bit right now, jumping up about 1%. Looks like most stocks are trying to pump a little bit. Let's fix this here. Actually, let me try this. I have a new button here. Let me see if I break something by doing this. Oh, that looks good. Look at that. So we could keep that up while talking. Although I should move, whatever. Okay, anyway, so a little more adjustments to do. But anyway, I'm playing with this new board. Sorry about that. You'll get to experience it a whole lot more if you want. If you join the courses linked down below, you get all those private live streams. All right, Fed remains highly attentive to inflation risk, using interest rate tools to deal with inflation, using balance sheet to address financial stability issues. That's exactly what I thought they would say. That, look, we're going to keep going 25 BP because we got to deal with inflation. But guess what? We got a whole tool belt, baby. Oh, you got some inflation? We got some pepper spray for you. Oh, balance sheet problems? We got some handcuffs for you. We got a whole tool belt. You want to keep trying us? I think that's what we're going to get from Powell here. Initial take on this per Wall Street seems to be slightly dovish. Does look like risk assets are moving up a little bit. Usually what happens, by the way, and I just want you to prepare for this. Usually what happens is we get a W, okay? So often, and not in this case because so far we're going up, but often we actually go down a little bit. I mean, maybe, I guess we still have 23 minutes. But oftentimes we go down going into the press conference. As soon as the press event begins right here, stocks hit a little peak. Then as he's talking, they tend to go down. And this is an average over the last 7 instances, what the stock market, the S&P 500 has done. And then towards the end of the day, they end up back up. So this is usually the kind of volatility pattern that you get per the average of the last 7 meetings from the Fed. But anyway, what do they say here? Inflation remains elevated, modest growth. They did tick us a little bit closer to recession. Recent developments are likely to result in tighter conditions for households and businesses and weigh on economic activity, hiring, and inflation. Hey, well, this is kind of what they want. A little bit of a slowdown in hiring because of the uncertainties. The yield curve has steepened. Markets definitely see this as dovish. The committee seeks to achieve maximum employment and inflation at a rate of 2% over the long term. In support of these goals, the committee has decided to raise the target range for the Fed funds rate to 4.375 to 5%. The committee will closely monitor incoming information and assess implications for monetary policy. The committee anticipates that some additional policy firming may be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive enough to return to 2% over time. Yeah, well, if you refer back to the 80s, over time was 20 years. In determining the extent of future increases in the target rate, the committee will take into account the cumulative tightening, the lags of which we've already seen. Future increases is very interesting because so far they're really only pricing for another 25 BP. So we'll see what happens there. In addition, the committee will continue reducing its holdings of treasuries, so no change over here. And second page, nothing really. It looks like this was unanimous. Voting for monetary policy actions were everyone. And the committee's assessment will take into account a wide range of information, including readings on labor market, inflation pressures, blah, 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 blah. Okay, fantastic. So we got the 25 that we were expecting. Markets taking this as dovish, though. Usually right into the presser, we have, a little bit of a slowdown, so that's not uncommon. Stock market seems to do that in a row. 89 out of 100 economists were looking for 25, so this is really no surprise. A pause would have sent the wrong signal. I think overall this SEP is not as dovish as the best case scenario, but it's decently dovish. I was looking for a little bit of a drop on that Fed funds rate projection. So unfortunately, it does look like they're hitting us with probably another 1 to 2 rate hikes. If you look at their statement and you hear them say increases, it implies 2 more. And if you look at these projections here, it implies 1 more. So one to 2 more 25 BPers. They are acknowledging the tighter financial conditions, which that's what's leading to that softening in real GDP and the central tendency for real GDP. Fed's message is clear here. These are now the Wall Street suits. So let's say what they have to say here. Wall Street suits. The Fed's work isn't done. However, the median projection as to where rates will be year end does show that officials are paying attention to stability concerns. Yes, in the fact that they haven't lowered it, or its optimism on inflation. Either way, dovish overall here. Bond yield steepening, looking for a little bit here. The language on ongoing increases implies some ongoing tightening. Yep, no kidding. Fed will continue, and we read through that already. Okay, so this gives you an update on what we got in terms of the 25 BP. My takeaways from this, all is normal. Okay, big bottom line takeaways before the Fed presser. Big bottom line takeaways for the average American, the average investor, whomever, okay? Big bottom line takeaways here. What do we got? We got, number 1, no Paul Volcker. There's no Paul Volcker. So if you're still sitting around really thinking the stock market's going to plummet on a pivot, you haven't listened to my explanation on a pivot. We've explained that many times before. I really don't want to go through it again. Basically, there's a pivot, and then there's the Fed U-turn. Generally, we want to invest where the Fed U-turn is, and U-turns usually coincide with not only a big mix in policy, but also bailouts, which we've started seeing some of those bailouts. So are we getting closer to a U-turn? I don't know, but we haven't seen any kind of Fed pivot yet. And honestly, I hate saying the phrase, but remember, folks, this pivot will occur when inflation ends. The market is worried about inflation not going away. Well, as soon as the Fed U-turns and changes directions, it means they have accomplished killing inflation to their satisfaction. The Fed is their problem in this cycle. In 2000, 2007, 2018, the Fed wasn't the problem. It was tech, it was real estate, and it was a lack of inflation. Those were the market problems before. Now the Fed's actually having to respond to too high inflation, so the Fed's creating its own problem. When the Fed stops fighting its own problem, that's a great signal. That means they've accomplished their goals, at least to some extent. So anyway, I'm pretty happy about that. Overall, I think this is kind of along expectations. We're not going to get a super dove here. We still got work to do. I was hoping it to be a little bit more dovish, but it's dovish enough, I think, to be satisfying to markets. It should give you confidence that we're not looking at a Paul Volcker. So that's number 1. Number 1, no Paul Volcker. Number 2, closer to potentially that accomplishing the mission, right? Number 3, we did get the Federal Reserve acknowledging that, yes, there are going to be issues because of the banking crisis. Those issues because of the banking crisis are specifically going to relate to tighter credit conditions. We've been covering those regularly. Those are likely to lower earnings per share for companies in the future. Specifically, in my opinion, SPY companies, S&P 500 companies, your consumer staples, your industrials, wouldn't surprise me. So Jerome Powell speaks obviously soon, but for me, average person here, no Paul Volcker is bullish. Overall, relatively dovish statement. Yes, still potentially looking at 1 to 2 hikes. And we'll see what Jay Powell has to say. Now, keep in mind how the market moves going into Jay Powell talking. I'm going to make this very, very clear. Out of the last 7 times that we've had these meetings, the average way that the market has moved is initially up, then you get a down, and then you get an up again right when Jerome Powell speaks. Then you get a down during his speech, and you end the day up. That's usually how the pattern goes. That doesn't mean this time can't be different, but that's typically what you see. So I think this is fantastic. Now, I know that some people say, oh, rate hikes are not bullish. I mean, the fact that some people were actually thinking there would be a pause here blows my mind. That would be more concerning. That would be concerning that something serious is actually wrong. Rate hikes at 25 are, in my opinion, very bullish because they mean nothing broke to an extreme level, and we're not visiting Paul Volcker. If we were getting rate hikes to the tune of 1% to 2%, 75 BPs, maybe over and over again, or 100 BPs, that would be bearish. A pause in this case, that would have been bearish. I mean, like, I don't know how you could say that a 25 BP is not a fantastic result so far. Again, Jay Powell will be talking soon, but this gives us a little bit of a heads up here in terms of a summary of so far what the statements show. Again, trending a little bit closer to recession, but the Fed refusing to really, at least in aggregate, believe that we are knocking on the door of recession. Remember, those estimates are an aggregate estimate of everyone. It's not like they collude on those, although they might anyway. And the other thing to remember is today's coupon expiration day. So get the best price ever. Link down below. Prices go up over time, and you get a price match guarantee in the event they were lower for some reason in the future. All right. Let's now listen into CNBC. What do we got over here?
I guess my final observation here is I think the yield curve is telling us that, going forward, a few meetings, even a few quarters, there is a disinflationary process underway. That's likely to be accelerated by the tighter financial conditions from the credit crunch. It's a matter of time before that, is really apparent and kind of taking hold, and the Fed acknowledges it. But I think that's what the yield curve is telling us, is that disinflationary process is underway. It's a matter of time, and that's why yields are lower in the future, at least priced in markets.
All right, Dow's down 10 points right now. S&P is still positive. We'll leave it right there. We know the real drama is often, at least for the markets, in the press conference. Thank you all so much for your time today. We appreciate it. And we'll hear from Chair Powell himself at 2:30, just about 13 minutes from now. We'll take you there live as soon as it begins. But first, we'll bring back...
Let's go to Bloomberg, see if they're awake. Flip around over here.
By 1/10%, on the Nasdaq up by about 0.5%. If you check out the bond market, that move sticks, down 10-11 basis points at the front end on a 2-year. Right now 4.058%, on a 10-year down 8 or 9 basis points at 352. Dollar weakness, euro strength. Euro's been gaining now for the best part of a week. Euro dollar 108.43, positive by about 0.7%. Dan Swank still with us. With us as well now is Matt Hornback, Global Head of Macro Strategy at Morgan Stanley. Matt, you've had about 16, 17 minutes to digest it. What stands out for you?
Well, John, thanks for having me on. And yeah, thanks for giving me some time to digest this. I think when I look at the message from the Fed via the SEP and their decision to hike rates, what strikes me is how they have balanced financial stability concerns against concerns about stickier inflation. And the way they've done it is they've told us they're going to hike less, but cut later. Hike less, cut later. That's the way they've decided to balance these two concerns. And that seems like a pretty rational decision. So I think the market should feel comfortable with this. The bond market, of course, is now going to have a very difficult time taking out these rate cuts that are priced in through the balance of this year. I would not expect the market to take those rate cuts out in the near term, and it could very well price in more cuts if the data deteriorate from here.
Well, Matt, let's talk about that. We're data dependent. I hear it all the time. At the start of the year, what happened was exactly what we're talking about. This spread between what the Fed was signaling and what the market was pricing. Market was saying rate cuts, recession's coming. Then the data just pushed the market to reprice, encouraged by the communication from the Federal Reserve. Given what's developed in the last couple of weeks, it's a new risk. It's financial instability. Matt, with that in mind, how sensitive will we be to traditional indicators, CPI, payrolls, when it comes to revising those rate cuts?
Yeah, I mean, I think that investors are going to discount data that looks fine and overweight data that doesn't look fine. And so, ultimately, if you have not an unemployment claims number that prints 200,000, pretty much in line with the recent trends, people will, think, you know what, that just hasn't felt the impact of what's going to come. Versus if unemployment claims surprises to the upside by 50,000, all of a sudden investors are likely to read that as recession is at our doorstep. So, that will be the bias of how I think people see data for the next couple of months.
And there's also this question of the terminal rate and where it ends up. The fact that it doesn't come down as quickly as people previously thought, Diane, raises this issue of whether the market is wrong in thinking that the last 2 weeks created an environment for even tighter financial conditions that would drag down growth the way that Priya Misra and Rich Clarida seem to be thinking much more than people thought, as well as where the Fed can cut rates to eventually.
Well, I do think that it is an issue. I think the Fed does risk at this point in time, even though all the data to date has been hot and strong. We also know all the seasonal factors that have contributed to that are going to reverse at some point in time as we get into spring. We've got another hot PCE number coming out that the Fed is staring down, and so they don't want to look weak in front of that. That said, I do agree that we're going to see some weakening, and we're actually going to see, like I'm worried about, that the employment situation is going to deteriorate, not a cliff event like we saw in 2008, but a slow erosion. And that's what the Fed is starting to look at, is they're sort of looking at eroding inflation slowly. I think that's a very nice way of thinking about it. It's not clear that that's exactly how it works in reality. We're now talking about a much more of a straw that breaks the camel's back kind of moment that we could see out there, not a cliff event, but a much deeper recession than the Fed would actually desire. And I think that's the challenge for the Fed, is how does it sort of say that it's allowing for that tightening of financial conditions, but also in allowing for it, is it going to be too much now on the other side of it? And we want to cool the economy. The Fed's goal is not to send the economy into a deep freeze.
Listening to Diane speak, it feels like the balance of risks has shifted. Matt, I'd love you to weigh in on how the balance of risks has shifted, how significantly.
Remember, Jerome Powell's in about 9 minutes.
Well, I think
the balance of risk.
Come on, Bloomberg, get it together.
Sorry, go ahead.
Matt, go ahead.
Yeah, so I mean, the way I see the balance of risk, they've clearly shifted to a weaker outlook for the economy. I think the Fed has acknowledged that in not so many words, but the press conference will be an opportunity for Powell to give us a different spin. But nevertheless, I think the balance of risks have shifted to the downside.
Oh, man. I mean, how many times have I explained this one? Okay, somebody here writes, how do you define a bailout? I feel like liquidity support isn't a bailout. A bailout is when investors are backed. That's what politicians are trying to make you think. Listen, a bailout is when the Federal Reserve comes in and backstops lending and backstops people's losses. I don't care if that's people who have car debt, home loan debts, bank deposits, investors. I don't care who it is. If somebody gets a big injection of capital to shore up their business, I call it a bailout. And the reason politicians today, if you listen to too much CNN, this is what you'll think. The reason you think politicians are telling you this bank liquidity facility is not a bailout is because they say, well, today taxpayers aren't on the hook. Well, guess who backstops the bank term funding facility? The Treasury Department. The Treasury Department has a facility that backstops this. And guess how that facility is funded? Through appropriations. Where do appropriations come from? Taxpayers. So in other words, taxpayers took money, threw it into a bucket. The Fed's like, okay, well, we'll use that bucket as our guarantee for bailing out these toxic banks. So if they default on our loans, well, then taxpayers will pay for it. So yeah, it's technically true that taxpayers aren't on the hook, but let's be clear, it's a bailout. And quite frankly, it is taxpayers bailing out the rich in Silicon Valley. Now, yes, to some extent, maybe it won't cost any money. Maybe the temporary sort of borrowing of taxpayer money for bailing out the depositors is a way of saying, hey, if we could shore people up with some extra confidence now, well, then maybe taxpayers won't end up having to pay anything. That's entirely possible. That's totally possible. But to make an argument that somehow, these liquidity facilities aren't the Fed swooping in and bailing out troubled assets is a joke. Capitalism 101. If bank fail, depositors lose money. Central bank comes in with bailout to prevent people from losing money. I don't care if it's shareholders or depositors. You being a depositor is you voting for the institution that you're trusting. That's the way it works. Now, our government has sort of rigged the way this works a little bit by introducing FDIC insurance, right? That is basically like a social safety net, right? But that's really a topic for a different discussion. Anyway, keep going here while we wait for Powell.
If he thinks the financial instability.
But you assume everybody, depositors, are experts in choosing banks. Dude, that's the stupidest thing ever. That's like saying that everyone who buys a stock, what you're saying is, if you're trying to tell me bank depositors are too stupid to pick a bank, you're telling me they should never buy a stock in their life because they're too stupid to pick companies. And you know what? They may be too stupid to pick companies. That's okay. But then you lose money because you made that choice. Don't tell me you didn't walk into a bank and realize that if you have deposits in excess of $250K, you didn't know there was a risk you could lose that money. That I don't believe that argument whatsoever. It is like pure stupidity. Anyway, we'll keep going.
Just to finish on euro dollar, 108.50, positive by 0.75%. So that's a stronger euro, a weaker dollar. With us still, Diane Swanka, KPMG, Matt Hornbecker, Morgan Stanley. Diane, history. We're always talking about history and this Fed chair, not wanting to be Burns, wanting to be Volcker. I wonder what history will look like when it comes to this decision today. Whether his biggest risk in this news conference is being Burns or being Trichet and hiking into a much bigger mess.
Well, that certainly is a risk out there. I think what the chairman is going to do is say how many options they have on the table and how closely they're watching everything, including the Treasury market. We saw the short selling that pushed the Treasury market liquidity way down to March 2020 levels in the wake of recent events. And I think that's very important.
We're going to CNBC to listen to Jay Powell.
Standard deviation for a wider angular strike.
They're killing us with a commercial. What is this crap? Dang it. All right, well, Jay Powell should be here any minute. We're about 3 minutes away from getting Jerome Powell rug pulled, and that's either going to be fantastic or it's going to be terrible. Technically, based on what we're told from smart people who make averages, out of the last 7 times that Jay Powell has spoken, the stocks temporarily peak at the beginning of the presser, fall during it, and then rally out of it. Now, we'll see what happens, especially with all the zero-day trading and options that's going on right now. It should be really entertaining. But anyway, we're about 3 minutes away. So I'm curious to see how BTC is reacting to all this. Right now, we've got NVIDIA up 4.4%, Enphase up 0.3%, GME is up 38%. You've got BTC USD is 28,550. Wow, that's actually pretty good for BTC right there. Reason for that is once you're over that 28.2 level, you're starting to ride on a Fibonacci. And I mean, who doesn't want to ride on a Fibby? I mean, that just sounds awesome. Yeah, anyway. Yeah, let's get ready for J-Pow here. Now, look, if for some reason you haven't been convinced yet to check out the programs on Building Your Wealth, go to send an email to kevin@meetkevin.com. McKay will take care of you, and we'll give us a reason why, and he'll send you something special. Send over an email to him. Anyway, let's listen in over here.
We're back to where we started. What do you think?
I would say it's an event. It's a largely as expected event, but I think the market reaction, at least initially, is an acknowledgement that the difference between a pause and leaving open the possibility of a hike down the road or a hike today and then becoming data dependent and more flexible as they did, not tremendous, not a huge difference, in the market had priced it okay. I would imagine Chair Powell might not want to make much news in the next hour. He may not succeed in that effort, but it would seem to me he wouldn't want the market to just race ahead and say the Fed is done, Fed is our friend again. And they also wouldn't want the reaction that said, policy mistake, they're over tightening, they're kind of insufficiently attentive to the financial stability risk. So to me, how he characterizes the level of alarm about banking stability might be the thing to look for.
Right. What would you be watching, Mike, as the press conference begins, and then in kind of the days to come as this thing shakes out?
Well, it's interesting. The market has in this little uptrend. We were at 3,800 on the S&P at the low a week ago Monday. That was down 6 or 7% from the couple days before SVB went down. So we had our little pullback. We've had our comeback. And now it's about kind of equal footing that we're on right now. I do think he might get pressed about the dot plot. I don't think the dot plot's terribly important, but there's some inconsistencies there, right?
Whoa, really?
Employment might be a little bit lower than we anticipated, but it's much higher than it is right now. And yet still we might be hiking and inflation's coming in a little hotter than we thought. But still, we're just talking about being data dependent. I think this is the way you get that muddled message near the end or transition point of a tightening cycle that's transitioning into something else.
Is that what this feels like to you, that we are coming close to the end of this tightening cycle?
Yeah, I think there's a general sense that what the Fed really does is get rates up as fast as possible, as fast as the market allows it, to the general zone that feels right for where we are, and then wait to see if there's some kind of adverse reaction. We got one, and there's some elegance to doing an exact 12-month tightening cycle. The upper end of the range now is 5%. Maybe you can soon declare some sort of victory on that.
And then when you look into the forecast for 2024 and
He should be coming out any second now. Presser's he's like never late. So let's go.
Mike,
Here he is.
We'll defer to him right now. Thanks.
Here he is with his papers. I told you he'd come out with papers. He always does.
Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
All right, Q&A now. I can't believe he didn't mention the coupon code expiring today. What is this? Yeah, everybody knows you can email me at kevin@meetkevin.com.
How confident
just
is
use
the
the code like
committee
that
that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased?
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
Zero.
So we did consider that in the days running up to the meeting. And you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected. And really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SEP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
So this talk about additional firming is basically, rather than saying ongoing hikes in this statement, they changed it to additional firming. That's what he's referring to.
Increases and firming. Does firming imply a rate increase per se, or could policy firm without you increasing rates?
Good question. Good question, Steve.
Yeah, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing.
Yes.
Ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. So.
Do you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular, our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first 5 weeks of the intermeeting period pointed to stronger inflation and stronger labor markets. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system, open market account, as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
They like their rate hikes.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation?
So Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision.
There's always one. There's always one person who asks these questions.
I realized, right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And so what we did was early Monday morning, we sat down and said, let's do this. And he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell, Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But but yeah, absolutely absolutely the same. The story is intact. So it's really three parts, right? Goods inflation has been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector. And that is that's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real. And that argues for, being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Gina. Hi, Chair Powell. Gina Smilik from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank, and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, in a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear to your last question. It's clear that we do need to strengthen supervision and regulation, and I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
And the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Go to Rachel Siegel.
Market's turning red on no cuts.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next.
Yes.
And that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong. It is sound. It is resilient. It's well capitalized, and I really don't see that as at all analogous to this.
Another question: would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome when a bank fails their investigations, and of course we welcome that.
All right.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky. So do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic. And then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right, we have a little more flexibility under Section 13.3. We've done quite a lot under discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC. So there's no risk in it for us.
Chris Rugaber.
Thank you, Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end?
No, absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood of credit tightening. We know that can have an effect on the macroeconomy, on demand, on labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
10 years down, 10 basis points, and that coupon's still
Hi, Chair
available
Powell.
today.
Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer term securities. Large scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating. But, nonetheless, what happened. And so that's really the purpose of one way to think about the review that Vice Chair bar is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible, regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Stunned.
Simon Rabinovich with The Economist. Thank you very much. Chair Powell, you've stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the Credit Suisse merger. I mean, wasn't that the big gorilla in the room? Didn't you breathe a sigh of relief when that merger happened? Thanks.
Sure. So, that was really the Swiss government. We, of course, were following it over the course of the weekend, and we were engaged with their authorities in the way that you would expect, all the ways that you would expect. It seems to have been a positive outcome in the sense that the transaction was agreed to, and it has been, the markets have accepted it, and it seems to have gone well. And I think there was a concern that it might not go well. So coming into the middle of this week, yes, I would say that has gone well so far.
Nicole.
Hi, thank you, Chair Powell. Nicole Goodkind with CNN Business. In the summary of economic projections, the FOMC sees the unemployment rate increasing to 4.5% this year. I'm wondering how you anticipate preventing this from snowballing while using the admittedly blunt tools at your disposal.
So that's an estimate of what will happen as demand slows and as conditions soften in the labor market. And it's a highly uncertain estimate. And there's really, we have to bring inflation down to 2%. The costs of bringing it down, there are real costs to bring it down to 2%, but the costs of failing are much higher. And if you read your history, as I'm sure you have, you can see that if the central bank doesn't get inflation back in place, make sure that inflation expectations remain anchored, you can have a long series of years where inflation is high and volatile, and it's hard to invest capital. It's hard for an economy to perform well, and we're looking to avoid that, and and to get back to where we need to be, back to where we were for a quarter century, and get there as quickly as we can.
But I guess the question is, historically, it's hard to.
What? Is she talking coupon? She's talking coupon.
Historically, it's been hard to contain unemployment, and the question is, do you worry about some sort of snowball effect, and how do you factor that into your projections and your thoughts?
Well, it depends on whether so recessions tend to be nonlinear, and so they're very hard to model. The models all work in a kind of linear way. If you have more of this, you get more of that. But when a recession happens, the reactions tend to be nonlinear, and that's so we don't know whether that'll happen this time. We don't know. If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, and because we know in the longer run that is the thing that will most benefit the people we serve. That's how we can have we've had very strong labor markets through these long expansions that we've had. 4 of the 5 longest, or 3 of the 4 longest expansions in U.S. history have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean. Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
You know, it's too early to say really whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that. You know, the question will be how long this period is sustained. The longer it's sustained, then the greater will be the likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and you know, we're certainly trying to find it.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, in particular immediate attention. That's and I guess there were 6 of them. So
and getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
That is a great question and is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. You know, what can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, you know, this review is going on. And, you know, I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. You know, it just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, you know, to this work, not connected to this bank. And under again, Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Ooh, last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, you know, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, you know, what will be the extent of it, and what will be the duration of it? And then, you know, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, you know, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, you know, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case. So that's all I have to say. So thank you very much.
All right, summary time. Dun, dun, dun. All right, let's see what we got here. This is going to be fun. I want to start with the interest rate probabilities. Well, Jerome Powell just gave us a beating, and it all starts with these interest rate probabilities, where you also have a convenient reminder of the expiring coupon code tonight and prices going up tomorrow. You get a price guarantee and lifetime access to any of the programs, most popular being Stocks and Psychology of Money, and of course, the 0 to Millionaire Real Estate Investing course, followed by the Elite Hustlers. All right, take a look at this. These are now, after the FOMC press conference, the implied overnight rates and the number of hikes/cuts. It's simple. You're going to look over here on the left side at the implied rate, which is creating this blue line right here. And so what do we think the rate's going to do? Well, the rate is likely to go up one more time in May. That is roughly sitting at a 50% probability right now. That's why you have the rate slightly below that 5. That's being priced into the chart. But you've got about a 50% chart or chance to get another 25 BP in May. Then the expectation is that we're actually going to get a 25 BP cut followed by more cuts, more cuts, more cuts, more cuts, and more cuts. This stands in the face of Powell because this suggests that rates are going to come down as much as 1 to 1.1%. So 100 to 110 basis points. This chart suggests 4 rate cuts here in 2023. Of course, what is Powell telling us? Well, good old Jay is telling us, hell no. In fact, that's not our base case. In fact, our base case right now is using monetary tools to tighten and firm up the system and squeeze out inflation. In fact, they expect to sit at a wonderful 5.1% by the end of the year. Not only do they expect to sit at 5.1% by the end of the year, which is the same as December, and they softened their outlook because they were going to raise their outlook in the last presser, Feb 1. They told us, hey, if we had to rewrite it from December, we'd probably include more rate hikes. But the reason they didn't include more than 5.1 is because they believe financial conditions have tightened so much such that we don't actually need to raise rates anymore because markets are going to do it for us. At the same time, we're getting pushed closer to a recession via these GDP projections, moving a tenth of a basis or a tenth of a point closer over here on real GDP and 0.4% closer for next year to a recession. Now, Jerome Powell had a lot to say, but a lot of it kept referring to this document right here. This document, which also has another coupon reminder there about 11:59 p.m. Right there, it says, the committee anticipates some additional policy firming may be appropriate. That used to say the committee anticipates that ongoing increases may be appropriate, right? So that's been changed to some additional policy firming. Jerome Powell was asked to clarify, what the hell is policy firming? You know, like what, it's going to get firm and then it's going to go soft? Is that like a reference, like a nudge, nudge, wink, wink? And that's basically what markets are assuming. But Jerome Powell says, well, by firming, we mean more hikes. Okay, fine. So more hikes. But what were some of the big things that led the market to actually go red during his discussion and his presser? Well, the biggest thing is, despite the fact, and this is by far the biggest, despite the fact that the market is pricing in rate cuts this year, as many as 4 of them or more, 4 to 5 rate cuts being priced in this year, what did Powell have to say? No rate cuts per the base case of the committee. Now, obviously, that could change. He made it very clear if inflation ends up being stubborn, then inflation will end up leading to more rate increases. Elon Musk is not very happy about this. Elon Musk makes it very clear that this rate hike is, quite frankly, foolish because it'll just lead to more deposit outflows. This is something he tweeted in just the last 20 minutes. When it comes to talking about inflation, which is the one thing that would actually keep the Fed continuing to hike, he's asked about disinflation. And he's asked, hey, look, you mentioned the word disinflation like 9 to 10 times last time. Is that still happening? Jerome Powell actually gave us hope here. He said, yes, disinflation is still happening. First, we have goods disinflation, which has been happening for 6 months. Home services disinflation, that takes time. But the good news is all the leading data, which has been consistent for about the last 6 months, is pointing to that in time, we're going to see a massive anchor of housing services disinflation. My expectation is you're actually going to get a beautiful marriage of this. You are going to get at the same time, and you want to prepare for this, especially if you're a stock investor looking at pricing power kind of stocks, whatever you're looking at. I would not be shocked, folks. Mark my word on this. Save this, put a sticky note on your desk, and hold me accountable for it. I would put an X right here, and I would say that come July, X marks the spot, baby. We get massive, mega housing disinflation, and we get the start to services disinflation, X housing. And what happens? The Fed goes, mission accomplished, baby, start cutting. And whoever thinks the market's going to go down when that happens is betting on stocks that they don't actually think could make it through a soft recession. But that's all right. That's all right. That's the debate, right? That's the debate. The bears are like, the recession's going to happen. It's going to kill earnings. And the bulls are like, dude, once inflation's gone, the Fed U-turns, man, we's going back. Yeah, we might have to go through a temporary, like, oh, hit a little bit of a wall there, but let's get out of it. That's why I personally pick pricing power stocks. But Jerome Powell made this very clear. Number one, goods disinflation happening for 6 months. Housing services still trending towards disinflation, just a matter of time before it shows up in the data. Number three, non-housing services have still not shown disinflation happening. Now, that's a problem. That's the sticky part, right? But I think come July, you can actually get all three of them. Think about what that would mean for a moment. If you got one, goods continue to come down, that would be fantastic, right? That's what you want. You want goods disinflation to continue to come down. As long as goods disinflation continues to come down and housing starts showing up and maybe services starts slightly showing less stickiness, then I think it is possible the market could be right and you could end up seeing some form of rate cuts. The problem is because we're not seeing number three yet, Jay Powell has to keep the hard face on. He's got to keep the attitude up that nah. We ain't going anywhere yet until we actually see that data. Now, unfortunately, because it's taking so long to happen, more problems are happening, including the banking crisis, Jerome Powell's response to the banking crisis and to recession. When he's asked about the possibility of a soft landing, he says it's too early to say. That wasn't fantastic. We don't love to hear Jay Powell say, I don't know. We're looking for the path to soft landing. That's what he said. I don't want to hear that because I like the Jay Powell that's like, we see a clear path to a soft landing. Oh boy, there's the soft landing and we're going to it. Oh, that's not what we got today. We got, yeah, soft landing would be nice, wouldn't it? Yeah, it's certainly possible. It's an idea, but we don't see it. But yeah, that's kind of what we got today, which, yeah, it's not that great. But anyway, then we got a little bit of a discussion on banking, talking about how history has shown that banking crises left unchecked are really bad, that they can cause more damage. That's very bad. We learned about, him saying that all deposits are safe. Now, I thought this was really interesting that he would say that. All depositor savings are safe. Now, he's asked, hey, why are you saying all depositors are safe? Are you basically saying FDIC insurance is now ramped up? Is it higher than what we expect? And what do we actually get as a response? He says, no, all I'm willing to say is what I said. Well, he said all depositors' savings are safe. And then he says, we have tools to protect depositors. Depositors should assume their deposits are safe. He's basically de facto verbally bailing out everyone's bank. That's basically what he's doing. Whether he has the power to do so or not, that's basically what he's saying. Now, He's talking about how the banking system is safe and resilient. Haven't heard that before. I feel like we heard that about Bear Stearns. But anyway, Silicon Valley Bank, he says, look, management failed badly. They didn't hedge. That's true. They removed all of their interest rate hedges. And one of the reasons you might remove interest rate hedges is because you have to book the expense for them. Whereas if you just hold stuff in held to maturity securities, you don't actually have to book those losses. For hedges, you do have to book hedges, though. So it made more sense to make the bank look more profitable, which is, kind of like fraudulent, but legal. So technically not fraudulent. It's just deceitful. The bank is basically able to say, well, let's just get rid of our hedge expense. And even though we're losing all this money, we just won't hedge it because don't worry, it'll be fine. And it wasn't. Anyway, so he talks about how this bank run occurred a lot faster than historically normal. Talks about how they're using an emergency facility. Essentially, that's the bank term funding program for basically taking bank toxic assets, recognizing them at full value, and taking on that duration risk. So that way banks can pay depositors by taking out loans from the Fed. Do keep in mind that's actually problematic for banks, because if banks are like, yay, we're operating, and then all of a sudden somebody's like, I want my $10 million of the deposits. And the bank's like, damn it. Okay, now we have to go borrow that money from the Fed. And we borrow 10 mil from the Fed, let's say, and go, here's your 10 mil. Now the bank lost that 10 mil in deposits, and they're looking at the Fed going, damn it, now I got to pay interest on 10 mil that I don't even have anymore. Like, it's like 2 middle fingers in your face. And so now the bank is paying interest on a deposit they don't have, and they're losing even more money. It sucks for the banks. This is why I don't want to touch any banks right now. People are like, when are you going to buy the dip on financials? I'm like, when there's no recession. So in 5 years. Oh, I wasn't supposed to say that. Anyway, all right. So consumer spending may have picked up, potentially due to weather. Inflation goal is still 2%. Next banking failure. Don't really see another banking failure, although there are risks going on. A lot of eyes on Pac West right now. But that's me saying that along with the research I've been doing. Implied year-end target rate is per markets is 4.28%. That's about that 1% rate cut is being priced in. Jerome Powell does not fear any problems in the commercial real estate banking sector. The NASDAQ is positive about 0.46 right now. Dow Jones, S&P flat to negative 0.25%. Oil actually up about 1.25%. Bonds actually sitting down about 12 basis points on the 10-year, sitting at about 3.489, somewhat implying more recessionary fears as we wait for that disinflation to roll around. Credit conditions tightening. Jerome Powell suggested that credit conditions tightening could represent the equivalent of approximately a 25 basis point hike. In the event that we have a 25 basis point hike, it is entirely possible that credit conditions would actually amplify the 25 BP hike that we have now or for May to make it feel like a 50 or a 75 or maybe even more. Jerome Powell made it clear that we don't know, analysts don't know, nobody knows how tight credit conditions are going to crush the economy. But he did make it very clear that tight credit conditions will weaken the odds of a soft landing. In other words, greater chance of rug pull. And it's hard to tell how long these tighter lending standards are going to affect the market, but they are going to be a critical factor that we have to pay attention to in markets today. Much like that coupon code linked down below. Life insurance you can get in as little as 5 minutes. 12 free stocks you can get with Webull, all brought to you by paid sponsorships. Well, actually, I guess 2 of them are affiliates. One of them is my courses on building your wealth. But anyway, there are services that I use. So anyway, those are my favorites. Courses linked down below, an expiring coupon code linked down below. These are all of my thoughts on all of this. Let me see what questions we have here. Somebody says, he says there's a path, we just need to find it. Yeah, no kidding. That's not very hopeful. Somebody else writes here, okay, well, yeah, the entire banking system's about 19 trillion. Yeah, don't worry, the Fed doesn't need to print all that. Well, the big banks ain't going anywhere. Then we got bigger problems. Banking. Oh, some of these comments are funny. It's all fine. The banking system is sound. J. Powell will use his firm tools. Yeah, I don't know what's worse, hearing that all is fine, or them acknowledging that no, things are not fine. You know, it's kind of one of those damned if you do, damned if you don't situations. We do notice that BTC is trending down a little bit here, looking at 27.6. And yeah, we got Tesla down 0.5%, QQQ up about 0.6%. So we'll see what happens. But that, folks, is the summary of the FOMC, and we'll see you later. Thank you for watching, and goodbye and good luck.